So if you're looking for operators like that, that's us. The other thing is that we can usually self-fund these deals. We don't have to have investor partners. And I think that that makes a big difference for people that are considering investing, like knowing that there's on the other side of the fence, the other team has something to lose. And we would have a lot to lose, probably a lot more than some would in the space, because our reputation is fantastic. We've got a 4.9 out of 5-star rating on all the review platforms. So I've been humbled by over $100 million worth of deals coming through our business, like humbled. And we get to manage these kind of resources for our clients. It's taken nearly 2 decades to get there. And I'm going to be brief with this. And this is important. Okay. Number one, you have to have disciplined acquisitions to do what we're doing. We submit over 100 offers to get 1 deal. Name a team that does that. We do. You have to have world-class operations. I know that when everything was going up, even the rookies look good. They covered up their bad mistakes because it was going up so fast. Nowadays, you have to have world-class operations. Insurance costs are up. Interest rate costs are up. Like, you got to be tight with your efficiency on the ground. We do that here. I would put up our team against anybody in the country for operations. The last thing is market timing. This is a little bit of a God thing, or maybe a good luck thing if you want to call it that. But market timing does make a difference. And when you've got people like John Gray from Blackstone saying that this is the time, you might want to pay attention to it. If you'd like to explore investing with us, go to homeinvest.com to jump on there. Now I want to get ready for the main event. I need you to type in the chat here. I need you to welcome to the stage. And I know that Zoom doesn't have a stage, but this is a virtual stage. And the more you actively engage, the more you actively learn, the more you'll retain. Studies show that you retain 92% when you're actively engaged. You only retain 51% when you passively sit back. So if you want to get a good ROI on your time here, then please help me welcome to the stage, Mr. Steve Werner. Woo!
What's going on, everyone? Welcome to today's Opportunity Zone. I see a lot of great people out there. Chris Lavin joining us from the beach, as always. We got Nate hanging out in the office. If you guys see all those books hanging out behind Nate, Nate reads all of those. He has a lot of knowledge packed in there. These guys are joining us from Florida. I see a lot of other people. I see Anyan here. I see Ralph. I think I saw Ralph. Man, if Ralph is not here, oh my goodness. I see Guy, I see Patty. You guys are hanging out with us on a Tuesday. We've got a lot in store for you. We're going to be going through the biggest news headlines. We've also got a great tax savings play for you guys. We're coming towards the end of the year. A lot of people are starting to look at their taxes. We have a phenomenal tax play for you. 50, possibly 75%, depending on how you invest. That's a huge savings on your taxes. If you have taxes due of 100 grand and you can save 75 of them, pretty big news there. We're also going to be talking about home sales right now. So right now, we have the most houses we have seen in the last 5 years. Inventory is at its all-time highest right now that it's been in the last 5 years, and prices are still not falling. Sales are not happening. We're going to be talking about what's going on over there. We're also going to be talking about people flocking to rentals. Rentals are going up right now. And we're going to be talking about multifamily and year-end planning. We've got all kinds of awesome stuff in store for you today. If you're new to our world, the gentleman that is joining me, let me pull Nate up here. Where is Nate at? Nate, this nice looking gentleman right here, is the founder and CEO of Home Invest. More than 20 years of investing in real estate. Absolutely awesome guy. My name is Steve Werner. I'm head of customer relations, and we are a Christian-based company. We practice Matthew 25. That's what our company is founded on, which is teaching you to be a great steward of what God has given you. Whether you invest with us or you invest with somebody else, it is your responsibility to go out, use what God has given you, and build financial wealth for your generations to come. For your children's children is how the Bible says it. Nate, how are you doing today?
Steve, that was a mouthful, man. I'm impressed. You got it all out there. I'm we had an awesome Thanksgiving here. I just feel very blessed. My family's very well taken care of right now. And what's even cooler is the opportunities that we have for the rest of the year. So there's a lot happening in real estate, and I'm excited to be part of it.
There's a lot going on. I took some time over the Thanksgiving holiday. I took a couple hours and just journaled out. I filled about, I don't know, maybe 10 or 12 pages of things. It has been a great year, both in real estate, in business, in my personal life. Like there are so many great things to be thankful for. It was a great Thanksgiving, and sometimes, I wrote the things that maybe I should have been upset about and did my best to turn lemons into lemonade. We have so much here in this country to be grateful for, and we have a lot to look forward to. I know we're coming to the end of the year. We've got some phenomenal deals. We'll be talking about that. How do we start everything at Home Invest, Nate?
You want to lead us in a prayer?
Yeah, we will say a quick word of prayer. If you're not a believer, that is okay. We'd still love to bless you. This will be pretty short. Dear God, thank you so much for the wonderful year in 2024 that you've given us. God, as we look forward to 2025 and what lies beyond, please bless us. Please show us the right decisions to make. Please help the people who are here to hear what they need to hear, to have the takeaways that they need to go out and take action. At the end of the day, it is all about finding your will in our lives. God, please bless us as we move through the day. Help Nate and I to share what we need to share on the show, and help the ears that need to hear it to hear. In your name we pray. Amen.
Amen.
All right. Nate, so many things going on, but we're going to start with the tax play. I know you're excited about this. Nate and I had a meeting this morning, and he wouldn't stop talking about how exciting he was about taxes.
Yeah. So once upon a time, I was a normal American and I just wrote checks to the IRS like everybody else. And then one day I learned from a family office, one of my clients, he hired me to help him with his real estate investing. And his family office, like really smart people that manage his money, they made me change some things and they taught me how to invest in real estate the right way, which then either reduced or eliminated my income tax. And it consequently led to stuff like this. Like this is from last year. I got a refund check. I had a really good financial year, but I still got a refund check because I learned how to take advantage of some tax breaks that come with investing in real estate. If you here right now would like to know how you can, instead of giving the IRS a big fat check, instead buy real estate that brings you cash flow, if you'd like to hear that, just type IRS in the comments. If you're following us online somewhere, type the word IRS. It'll help us know too, but type IRS. I'm sure the IRS will love that we teach this today. They'll probably come knock on my door at some point and say, Nate, stop showing this. But there's a loophole. It's not a loophole. It's actually a legit thing. It's called passive losses. And it works like this. We have this beautiful 72 unit building. This particular one, the IRS lets us hire someone to come in that's a tax specialist. They understand buildings, building code, and taxes. And they let us come in and do this report called a cost segregation study. I know that's a really big word, but just understand that it's just a specialist that helps write this report on how much tax benefits you can take. And because this one came back so favorable, we have some extra tax benefits that we can share with investors who invest in this deal with us. So literally what it looks like is that when an investor comes and puts $1, I'm using $1 as a simple example, but if they come in and they put $1, I'll use 100,000. If they come in and they put $100,000, they can be eligible for up to $50,000 as a tax back, almost like a credit. They can use that against ordinary income as long as they structure the right way. If you're wondering, well, Nate, what does that mean? How does that work? I'll explain it to the best of my ability. I'm not your CPA, but I'm happy to talk to your CPA. We talk to a lot of people's CPAs here. In fact, that's what led someone like Matt Lewis, one of our clients. He talked to his CPA and said, hey, I'm getting hammered on taxes. How does this work for me?
We don't have an issue. Can you hear me now?
Hang on.
There we go. We got it?
Yep.
Okay, cool. And so he came to us with a similar challenge. He said, "Hey, how do I knock out
I
my
was
taxes?"
speaking. I was speaking, but
There we go. And so we ended up helping him to a point where he was able to get a massive tax break from investing into a real estate deal with us. And so this stuff exists. It's been around forever. We have one more year of bonus depreciation, which simply means we get more than usual of these tax breaks. We have one more year to do that until some of these tax loopholes start to expire. So what is it on? It's on this beautiful 72 unit building. It is in Georgetown, Kentucky. This building right here, it's in literally one of the best suburbs that you can possibly be in the Midwest. Georgetown makes around 74 grand per year income wise. So it's way above the average for the Midwest. And they've got jobs galore and population galore. Literally, Toyota just invested, or they're investing $1.3 billion just down the street from our property. And so we know that what happens when there's more jobs, rents typically continue to climb. So for us, it's just a solid investment all the way around with tax breaks on top of it. So if you're looking for a place to park money that earns you a really good return and potentially a massive tax break, this is probably the one you should pay attention to. There's tax benefits anywhere between 50 and 75% that are available for folks that structure the right way. All you have to do to learn about this is jump on a quick call with us. If we could drop the link in the chat, I'd appreciate it. And if you're following us on social media somewhere and you don't see a link, just type the word link, L-I-N-K, and we'll fire it over to you in a private message. We've got 3 different investment tiers available. The first one's for folks that are doing $100,000. The second one is for folks that are doing 500, and the third one is for folks that are doing $1 million. There's literally dividends that are paid quarterly on this property, right from day number 1, and there's massive tax benefits available for everybody who's invested into it. Steve, I'll leave it there for now, but that's the overview of the deal.
Awesome. I am just grabbing the link. Usually Sue is here, but Sue, I think, is a little under the weather. You can click the link that is in the chat. If you are following us on social, just click that you would like to book a call and we will get you a link. Those pictures look so nice. I love the green grass and the rolling fields. And it's not too far from your cabin, right, Nate?
No, I will actually be on site at this property in 2 weeks, and it's really close, about maybe 30 minutes from my cabin.
Nice. Well, if you guys are looking for the news, we're going to jump into the news. There's a lot going on. Since the election, things have kind of been going all around when it comes to news, but numbers have kind of held. One of the numbers that I want to talk about and share with you guys, actually, I want to make sure it's up on the screen here, and I'm going to share this. There we go. Supply of existing homes for sale is at a 4.5-year high. The thing is, like, houses, the inventory is growing, but sales are not really growing. We saw interest rates come down just a little bit, about 0.1%. This article talks about that, but it talks more about where rates are right now and what we can expect to see in the future. They're saying, it's going to depend on what Trump does. Do you think, Nate, Chris, I see you there with your arms crossed. I know you've got thoughts about this one. What do you guys think is going to happen? I mean, we're seeing inventory build and build and build. Nate, you and I were talking about this a year ago when Airbnb stopped being as good as it was and people started listing houses. Everybody said, well, once we have inventory, we're going to see prices come down. Well, we're seeing inventory build, but we're not seeing prices move and we're not seeing people buy. What do you think's going on? Chris, you can take this one.
All right, no, go ahead, Nate.
Feel free.
All right, so crystal ball time, right? So I believe that people are not dropping their prices. They've rushed to market, putting stuff up post-election, right? Waiting for everything, for the mortgage rates to fall. So they're still in the belief system that it's, as we cross into the beginning of next year, the new presidency, that the rates are going to plummet and the value of the house is going to remain. And so they're getting to market and staying in the market. And that's just the way it is.
Nate, you think that that's what's going on? Do you think we're going to see rates drop when Trump gets in office?
I think it's total crystal ball guess at this point. But if the Fed wants to maintain face, yes, they do. They forecasted 8 rate cuts. They've executed now on 2 of those cuts, so they've got 6 more that they should do. But let's kind of see where it goes. I think that they will do at least a couple more to do what they said that they're going to do, but let's see how long it lasts.
I mean, my thought is they came out. I mean, one of the articles that we shared last week on the show was about how inflation's actually ticking up a little bit. And they have, I mean, you remember Jerome Powell saying, like, we're not going to cut rates until we hit 2% inflation. And inflation actually ticked up a little bit over the last couple of weeks. Seeing that happen, I don't know. I mean, we'll see. Trump has a lot of levers that he's pulling. A lot of speculation right now. So we'll see what actually happens when he gets in. I think you are correct. I think it's a lot of crystal ball talk, but I think we might see stuff. We might see inventory keep building. Kind of brings me to our next article. So the next thing that I want to talk about is people moving into rentals. So Nate and I, this is something else, if you've been a long time listener, we've been talking about for a while. When the economy gets a little bit tighter, people tend to go towards rentals. Well, we're seeing that in an exaggerated fashion right now. The gap between being able to buy a house and being able to rent a house is getting larger. We're seeing people that need to save money. They need to cut back on their expenses, and they're looking to jump into rentals because you can rent a 2-bedroom apartment for a lot less than you can buy a 3-2 house. So this article, this is by the Joint Center for Housing Studies from Harvard, talks about, I thought there was an interesting point down here. Fully 24% of homeowners were burdened by housing costs. That means that they spend more than 30% of their income on housing. But what's really crazy is down here, they talk about the number of people that are spending more than 50% of their income on houses. And that number has continued to go up. What does this mean? This means that housing costs are going up. That's what happens when interest rates go up. If you look back at like the late 70s, early 80s, when housing interest rates were 13, 15, 18%, you saw the same kind of thing start to happen. What does this mean, first off, for renters? And then secondly, for investors, Nate? I think this is a great time to be getting into multifamily. I'll throw the ball to you.
So it's interesting. One of the articles that I'll foreshadow this, but we won't get into it quite yet. But multifamily right now, we saw this huge delivery of new construction hitting the market. That's been happening for about the last 12 months or so. It's about to die off though, because a lot of the interest rates got too high for builders, and then inventory for them, like they're not going to go put their money against a bank loan that's too costly. So inventory starts drying up. And now what you're seeing is that prices are going up on rentals. There's more demand in the article that you're pointing out right now, Steve. It's putting more demand on rental property. People don't want to own, they want to rent. And so what's going to happen? Rents are going to keep lifting. They will lift next year. Yes, there's still more new construction that needs to be delivered, but as soon as that's absorbed, we will see rental prices continue to lift. Well, that's the fate of the US rental market.
Yeah, prices will continue to go up. They will be less than single family houses, I think, for a while, till we see interest rates really correct. And even then we might see houses, just because it's got to catch up to inflation. Renting is going to be cheaper. And as long as that's true, there's going to be a demand for it until we're back into a boom market, which could be a while. So for investors, go ahead.
You're right that boom market, it's a ways out. Wages have to severely catch up to the inflation that single family houses went through. Single family houses in some markets literally doubled in 3 years. Wages did not double in 3 years. People can't afford to go buy the single family house right now. That's why there's this stalemate still happening. So until that happens, that big jump that you're talking about, it's not going to come, not until wages are there.
Yeah, Chris.
I agree 100%. I've got a perfect example. I've got a son that left Florida 4 years ago to go to Nebraska. And housing costs are significantly cheaper there. But Florida, as everybody knows, has been one of the unicorns where prices have doubled and tripled over the past 4 years. He physically cannot afford to come back and live where he lived previously. It's just absolutely insane. And we're going to keep seeing this and keep seeing this until, like Nate was saying, the wages catch up to inflation and the cost of single family housing. And the other thing that is going to continue to drive rents up is because it's cheaper to rent than it is to own at this point. As we see people aging into wanting to acquire their own domicile, their own place to live, they're going to start sacrificing the house for the location. Like people that come to Florida who originally had an intent to buy, realize that they can't, still want to be in Florida, so they're renting. Therefore, drying up the available inventory, and it's really great for investors at this time in the multifamily space.
Yeah, absolutely. We talked about building last week. If you guys weren't on the show last week, builders, what happened is we're seeing all the completion from 2 years ago, 2.5 years ago, and moving forward from about the last year to 18 months, builders have not been taking on building new projects. We're actually at a shortfall of new builds, which is going to lead to the price of rentals going up because supply and demand. There's not going to be that many rental units available. There's not going to be new ones coming onto the market. There's more demand, which means prices are going to go up. And maybe you can break down NOI for us really quickly, Nate. Apartment buildings are valued differently than single family houses. They're valued based on what we call the net operating income, which is actually driven by rents. Nate, I'll let you break it down a little bit more.
Yeah. So you've got all of the income that a building collects, laundry income, pet income, rental income, fees, etc. That is called your gross operating income, gross income. That's the very top line number. Then what happens is that you have to pay people to run a building. You've got your staff, you've got your cleaners, you've got your electricity bill for the common spaces. You pay for all of those expenses, and now you have your net income. The net income is how we measure the value of an asset. Each property in specific markets, the measurement basically works like this. It's net operating income divided by whatever the market area capitalization rate is. I know that's a big word. You probably hear it as the small word cap rate very often. It's just a measurement of what properties typically trade for in an area. What are they selling for as a common denominator? You divide net operating income by whatever the area is trading for, and that's the value of the building. It's pretty scientific. All the appraisers use the same method to come up with valuation for buildings.
So that's going to lead us into our next article, which is actually about how cap rates are going up. This article gets a little bit into the weeds, but basically it's saying multifamily demand is way up right now. Like it has double-digit increased from last year, and we are just going to keep seeing this go up. So sales volume increased 18% year over year, while prices fell a little bit. We're seeing this, and this is what has allowed us, if you guys have been paying attention, we've got some phenomenal deals this year that we took down. Nate, do you want to talk about why sales volume is going up right now and prices are changing?
Yeah, we sounded the warning bell about this roughly 4 months ago, maybe 5 months ago, when Blackstone, John Gray, this is the world's largest landlord, when he said prices have hit bottom. I don't think he was wrong. I think he was spot on, depending on the zip code that we're talking about. And then he further backed it up by committing billions of dollars to be thrown at multifamily as fast as possible. And now other people are catching on to that. And where we saw the big uptick is in month over month. So literally, if you look at October this year versus October last year, we saw an 18% jump increase. So there's more people now jumping back into the multifamily game than there were a year ago. I think that a lot of it has to do with there's some peace in the air now that we know who the presidential candidate is or who the president's going to be. I think that there's some solace to it. There's some folks that are just taking a deep breath and saying, okay, there's certainty. I know what's going to happen. And so now there's money moving. And so although prices have not jumped that much yet, I think that they will. We're still sitting in that trough period where prices are still a little bit low. Actually, they're quite a bit low. They're 30% lower than they were 2 years ago, which is awesome for us. And this, from this moment forward, so let's mark it. It's December 3rd, 2024. We can come back and watch this in the future. I think that we see prices shifting up almost every single month for at least the next couple of years.
Yeah, I think we're going to see prices start to go up, and I think we're going to see it harder to find great deals, which is one of the reasons that I would love to point to us at Home Invest. We are masters of finding off-market deals. Most of our deals come to us through off-market channels, conversations that we've had going for years when people are ready to sell. I mean, the tax play that Nate laid out for you, we've been working on that property for years. We bought it completely off market, 30% under rent, completely full. And it's a phenomenal, like it's paying out very well and offering great tax dividends. That's how most of our deals are. Those deals are getting harder and harder to come by. Nate, how many properties do we underwrite in a given month?
Chris and I just took a call with our team yesterday, and they had 120 with one particular person that they're submitting offers through. 120. And of that, we've only gotten one of 120. Imagine that.
But that one is a golden deal.
Hey, can I interject something?
Yeah.
Let me just interject something. So if you're watching us right now, and in the back of your mind, you're thinking, 10 years ago, I should have bought Bitcoin and I should have stayed in and looked at Bitcoin. Please, for the love of all that's holy, please, if you're in a position to invest in multifamily real estate, now is the time to do it. We've only seen these market trends how many years, Nate, between the bounces? It's been 20?
2009 was the last one.
So 2009 was the last bounce. We're at the bottom of that bounce on its way up. Get in now, get in on a deal that you're comfortable with so that you're not sitting there saying, man, I should have gotten involved in multifamily real estate 2 years from now, where, at 5 years, you could be actually doubling your money in a safe investment. We're telling you these are market predictors, and we can see what's going to happen based on our experience between interest rates, inventory, and demand. Now is the time. Now is the absolute time.
Yeah, absolutely. The best time to plant a tree, 10 years ago. The second best time to plant a tree is today. If you are thinking about investing, you will look back on this investment a couple years from now when it has done very well. Historically, we've returned over 22% to our investors. That does not mean that that's what we'll always do in the future, but that's what we've done historically. We're very safe in our underwriting. Nate, do you want to talk about the deal that we have for taxes one more time? And I will see if I can find the OM, or maybe you have it.
Yeah, it's this 72 unit building, and it's got all this green space because it's in a city called Georgetown. Georgetown's very famous for thoroughbred horse breeding. So think of like all the fancy racehorses like Secretariat that you probably heard about. Secretariat literally retired in this city, and most of them are born and raised here. And so you've got sultans from the Middle East flying in jumbo jets to come check out these horses and buy these horses. You've got money flowing, jobs are abundant, all that kind of stuff. But this building literally resides between a couple of large estates, multi-million-dollar estates. And we've got one of the very few multifamily properties available. Nobody wants to sell their horse farm to a developer. So right now we've got kind of a rare little thing right here. It's 100% occupied the day that we took it. We're going through and we're basically renovating units, one unit at a time. And all that we're doing is we're taking the rent roll from where it's currently at, which is at $1.19 per square foot. The seller on it just didn't bump the rents, and we're taking it up to market rent. Market rent is right around $1.57. You can see the comps that are popping up on the screen right behind this, my little image. It'll be really easy for us to do this. We will have it done somewhere between the 3-year and the 4-year mark. And that's how we can double someone's value. It's how we can double someone's money, because as Steve described, net operating income drives everything. Today, the NOI, the net operating income, is a little bit low because the seller kept rents low. We're going to go in and bring those rents to market rate. And then that's going to help us achieve the valuation that we need for the building. And then we'll sell it, we'll cash out, and everybody gets to celebrate with victory. In the time being, it's a massive, massive tax break for everybody. This is one of the best that I've seen this year. The tax benefits that Trump had enacted back in 2017, this is the last substantial year for them. There's a little bit left next year, but this year is the year where you can actually grab a big bite to save on taxes. So this is your tax haven of 2024.
Chris?
Chris
Don't get me just sitting there nodding his head.
I love this property. And the reason I love this property is it's 100% occupied. So that tells you point blank that the rents are too low, way too low. You want to be at like 95, 96 is beautiful. 92 is great. But prior to getting involved in this property, I reached out to other landlords in the area asking, what's going on. Everybody is 100% full because there's no development happening there. There's an investment, another $1.5 billion investment by Toyota to expand the job base. They currently have 9,000 employees. It looks like they'll double that. Where are these people going to go? There's no building going on. So this is going to be a beautiful place for us to increase the value of this property without even trying hard. We're just doing the normal right things to do in a property. We're polishing it up, painting, turning over some of the units as they lease up, and the rents are just going naturally. We don't even have to try hard. This was a grand slam home run. But man, it was a deal that took us a lot of work to get to, and to finally get it into the position we needed it to be to make this profitable for everybody. So again, please don't kick yourself next year when you've missed out, on this tax savings opportunity and this investment opportunity. You wait till the other side of January and you won't be able to get the benefits. Please call an advisor. Please talk to Sue. Please talk to Steve. Get involved if you're going to do it so you don't miss out. Once it's gone, it's gone. And it's not us, it's the government.
Yeah, you cannot roll back the clock. If you're looking at your taxes, or if you know that you're going to have some tax liability before the end of the year, which I think most people will, this is a great way to mitigate it. And it's a phenomenal investment that will pay you for years to come, as well as saving you on your taxes. Nate, I want to transition our teaching for this week, which has to do with waterfalls and investments. I actually somebody sent me a syndication to review about 2 weeks ago, and it did not include any tax benefits at all. The GP was keeping all the tax benefit for themselves. And the person that sent it to me said, well, I didn't even know that you could get a tax benefit. What does it look like? How do people take a tax benefit on their K1 through a property?
How do they take it, or how do they take it away? Sorry.
How does somebody use the tax benefit? Is it difficult? Easy?
No.
Let's explain it and break it down.
Yeah, it's really simple. So when you pick a deal, let's just say that the deal that we had up on the screen, I'll put it up as an example right here. So let's just say you say, you know what, I'm in on this deal. You get allocated a percentage ownership of that deal. Let's just pretend that there's 4 owners of it, and we each put in equal dollars as investors. Then we each have 25%. So what happens is that the tax benefit gets divvied up, usually according to the percent ownership that you have. Now, the US law allows you to actually split it up however you want, but for simplicity's sake, we're just going to say that each person gets 25% of the tax benefit. I'm going to zoom in on this part of the screen right here where it says year 1 additional deduction. Let's just pretend that this is the tax benefit, because I've got it on my screen right here. This is $1 million right there. If I had 25% of that, that would be $250,000 of tax benefits that I could take on this particular asset. And so all that does for me to claim that is that when I get my K1. It's a document that the partnership sends to you to file your taxes. When I get that K1, I give it to my CPA and I say, hey, look, I've got the golden ticket. My K1 says that I've got passive losses of 250,000. I want to apply this on my taxes. And then my CPA will then deduct that against in my case, my ordinary income to reduce my tax bill. Imagine if I would have went out and sold boats and I made $250,000 selling boats, but then I have this beautiful K1 over here that says I've got a $250 passive loss. I can use that passive loss against my ordinary income. Now you have to be structured the right way. Not all CPAs know how to do this. And so if you're getting any pushback from your CPA, or they're like, hey, I don't understand this, that's where you really need to jump on the phone with our team and we can help walk them through that conversation so then they understand how to actually apply it and how to do it the right way. There are some rules and regulations to it, and we help people with that all the time with their CPAs.
Awesome. The other great thing that I want to point out is around if you're involved in a deal, Nate and I's job here, Chris as well, is to point you in the right direction for your investment dollar. If you're talking to somebody that has a syndication offer, and they don't offer you tax savings, or if they don't know what the tax savings are, they haven't done their cost seg study, you're probably going to want to look at that deal with some scrutiny. You're probably going to want to find a different deal. We always make sure that we pass along a huge amount of tax savings. On this deal specifically, we can offer anywhere between 50 to 75% of your money back to you through tax savings because we know our numbers. And we're willing to pass along that savings because we want to see you guys win. Nate, I want to talk about some other things that people should look for when they're when they're talking to people about syndications. First one being a flexible waterfall versus a fixed return. So we do everything either 70-30, 75-25, or 80-20 based on the amount of investment. What is a flexible waterfall?
Yeah, I got one sent to me over the weekend from somebody else. And when I was looking at it, I'm like, oh my goodness, that's like the most complicated thing ever. They had to actually draw a diagram of how the money was flowing. It's not pulling up right now. Anyhow, when I looked at the diagram and I'm like, I don't understand how the money is actually coming to me, I immediately knew this is not a good thing. Like, there's no way. When it's so complicated, you can't understand it with just a quick napkin sketch. It's usually because there's hidden fees or it's some kind of, I don't want to use the word trickery, but like, it's just not being transparent and open book the way that it should be. What you really want when you get into a deal is you need to be able to explain it with simple words. I got a 10-year-old boy. I can explain every investment that we get into to my 10-year-old, and he can understand it. He can comprehend it. If you can't do it at that level, it's probably something going on that at least I wouldn't want to get involved with it. Flexible waterfalls, every time that I've heard about people getting into them, they usually regret it.
Yeah. So the way that I like to explain a flexible waterfall, if we agree, you come into the deal, we're going to give you 30%. We're going to take 70%. Actually, it's the other way around. You're going to take 70%. We're going to keep 30% as the managers. And that's the fixed return for the life of the investment. What a flexible waterfall says is, as the building goes up and starts to make more money, as the GP, we're going to take a little bit more and we're going to give you a little bit less. And they explain it through, well, you're going to make the same return because since the value is going up, you're going to make this fixed return across the years. And we're going to keep all the extra because we're the ones doing the management. That is something that you want to watch out for. If people start talking to you about that, if they show you something that is super complicated, run the other way. That would be my advice. Chris, you're nodding. I mean,
Oh,
Chris,
yeah, the deal's too good to be true. It probably is. Simple is as simple does. So, yeah,
I mean,
like
Chris,
it simple and straightforward.
Chris, you've built multiple companies. You've been involved in huge deals, and you still preach that simple works, simple scales, complex fails. The same comes
Absolutely,
for investments.
100%. 100%. 100%.
Awesome. Well, Sue, if you can put the link in the chat one more time. Kate is hanging out with us. Let's say you invest $100,000. What is your savings off that 100,000? So 50 to 75%. You are correct. Nate, do you want to break this one down? If Kate, we know Kate, if Kate invested $100,000, how much would she be able to save off of her taxes this year?
Yeah, and I'm going to say this with confidence because I know that Kate structures, or she will structure the right way. I can't give personal tax advice. None of us can because we don't know how you structure. But as long as you structure it the way that I'm about to describe, then this is all Americans are eligible for the same exact tax benefit. So what happens is that $100,000 in is qualifies for roughly $50,000 as they call it passive losses. I'm going to call it today for simplicity a tax credit. Know that your CPA will not call it a tax credit. Your CPA will say, what is that? You don't get those. It's called a passive loss to your CPA. But you put in $100,000 and you get back $50,000 on year number one. I use those as tax credits. My CPA calls them passive losses. You get about $50,000 in year number one. You get some more next year, and you get some more usually on year number 3 and year number 4. But year number one, that's the most substantial. That's the big one. That's what everybody wants for this tax year. So $50,000 is the simple answer, though, on a $100,000 investment. Those of you that are doing larger amounts, like we have another partner in this one that put in $1 million, with the bigger dollar amounts, we give a bigger tax advantage as well. So you're eligible for up to 75% on larger investments.
Awesome. Sue put the link in the chat. If you would like to reach out and talk to us, you can talk to me, you can talk to Sue, you can talk to Doug. All of us would be happy to talk with you about this. And to Chris's point, as we come towards the end of the year, we have about 3 weeks left for you to take advantage of the tax savings on this year's taxes. And once we go past January 1st, you're not going to be able to take advantage of these anymore. It's going to have to go towards next year's income. So do yourself a favor, jump on a call with one of us. We'd be happy to talk with you guys. And that's going to do it for the Opportunity Zone today on December 3rd. Wishing you guys an amazing day as we move towards the Christmas season. Hope you guys get your Christmas shopping done, relax a little bit, and find a great investment to save on your taxes. Nate, Chris, anything to say before we jump off?
I want to say one thing before we jump off. December 31st is the IRS deadline. Nate and I jumped on a call with another syndicator last year in the middle of January with a bunch of attorneys, and they tried to sell us that we could get the tax benefits for the previous year if we invested in January, only to find their own attorneys after we talked it through telling them it was illegal. Beware of those deals. December 31st, you must have ownership. Beware of those deals. That's all I got.
Perfect. All right, guys. So when we close down the Zoom room, those links are going to disappear. So we'll leave the Zoom room open for a couple minutes. You guys can click on there. If you're following us on social media, just put the word call in the chat. Ralph, good to see you. I was looking for you earlier and you were not on. I'm glad you're here. Zoom in. Wishing you guys all a wonderful holiday season. Hope you guys all had a happy Thanksgiving, and we will see you next week here on the Opportunity Zone. Goodbye, guys.